Hi, and thanks for joining us. My name's Craig West, CEO and founder of Succession Plus, and today's session is titled Strategic Sales, but importantly, it includes the number one tip or the number one thing you can and should do to exit for maximum value from your business. And obviously, that's a topic that everybody's interested in. I want to start with a quote first from Warren Buffett. I quote Warren Buffett a lot, obviously a very, very successful investor, and he says a lot of things that are quite meaningful and useful lessons for business owners to understand. Price is what you pay, value is what you get. And what we're going to talk about today is how we determine strategic value for our business and how we can exit for maximum value if we think about it properly. A couple of key things we're going to think about before we do that. There's a couple of key strategies we can actually use. We can think about strategic acquisitions, and we're going to talk about some recent examples of strategic acquisitions and how we might be able to use that strategy. We're going to talk about listed companies and how we might take advantage of that, and offshore buyers, always an interesting topic, but one we shouldn't ignore. And then we're going to finish off with the number one tip, the thing that really makes a difference in terms of maximizing the value of a business. So let's get into it and start with some traditional numbers. I guess not very exciting, to be honest. The traditional multiples for small to medium enterprises here in Australia, they're not great, and they've been coming down for some time with the large supply of businesses that are somewhere between $1 and $4 million in Australia, typically, somewhere around the 2 times, but often quite a lot less. There's lots of examples. The average is probably around 2.5 for larger businesses. But for these ones between 1 and 4 million, you can see at the moment, 2019, they're probably around 1.5 times earnings. Not very exciting. And in fact, I tell most business owners not to sell if that's the case. I wouldn't sell my business for 1.5 times earnings. It doesn't make any sense. So we have to work out how we can maximize that multiple. The first thing we can think about is strategic acquisitions. They're actually quite a useful and sensible way to think about maximizing the value of our business before we sell or exit. Let's have a think about what we're trying to do here. Everyone's heard the saying, how do we get 1 + 1 to equal 3? And in fact, we can probably, in this example, get 1 + 1 to equal 5. But let's have a look at what that actually means and what we can do about it on the way through. Firstly, let's start with some examples. And I want to talk to you specifically about strategic acquisitions. We're going to use some well-known household brands, much bigger businesses. But importantly, these much larger corporates and larger businesses are often buying smaller businesses. They're not always buying massive companies for billions of dollars. Sometimes they buy quite small businesses. Interesting quote from Tim Cook, very recent interview with CNBC, talking about the fact that we acquire everything that we need that can fit and has a strategic purpose to it. And there's the key word, strategic purpose to it. Again, recently at the Berkshire Hathaway AGM, he was also quoted as saying that Apple is primarily looking for 2 things, talent and intellectual property. And significantly, in the last 6 months alone, Apple has already made 23 acquisitions. We're not talking about 1 or 2 a year here. We're talking, on that average, we're talking 50 a year. They're quite prolific. Importantly, as I said just a minute ago, some of the acquisitions are small. If you think about some of the businesses they're buying, you'll see straight away there's a direct strategic connection. If you look at Texture, for example, it was a digital subscription model for magazine publishing. 12 months after the acquisition, Apple's now released a new subscription service called Apple News Plus, directly related. And they've done several of these acquisitions. In fact, they've done multiple acquisitions over a long period of time that bring into the business IP, talent, and new products that Apple can then use its massive market reach to amplify right across a larger, broader audience. Here's some examples. This is not all of them, just a list of recent Apple acquisitions since 2018. You can see all of them related in some way to some part of Apple's business. If you look at the actual industry or the application that these businesses have developed or the area that they operate in, you'll see a direct relationship to Apple, and there is a strategic reason why Apple's actually buying those businesses. It makes sense for these to be bolted on or added to Apple because it's all about new product, new technology, improving existing services or products, And strategic acquisitions are a great way to do that. Look at Microsoft, similar sort of thing. You'll see again here, large numbers. These are only in the last 6 months. There's several of them sitting here. I think there's a list of 7 or 8 on the screen. Again, all related to Apple's existing business, strategic acquisitions, and nearly always they pay a lot of money for these. They pay a premium because these businesses have got IP or talent or particular brand, trademark, or product that Apple really wants to leverage, and Microsoft the same. Here's an Australian example. It's not always just high-level IT deals. This is a consulting firm at the end of the day, and it's technology related, but it's consulting and services into this space. And this is KPMG, and KPMG has done this a number of times, as do most of the other major 4 consulting firms here in Australia, and it happens regularly. Why is this important? And I guess the key thing to understand is, what is the buyer looking for? Why are people in this strategic acquisition space prepared to pay more? Why, for example, does Facebook pay $1 billion to acquire Instagram? Why do they pay these big numbers? We've got to understand the motivation of the buyers. And the research is quite clear. The research tells us there are some strategic value drivers. The buyer motivation, if you look down the bottom of this slide, complementary products and services. About 36 or 37% of these acquisitions are driven by complementary products and services. Things that can be instantly added into your market chain and sell to your customers, give you leverage. Market niche is also important, and geographic location. They're the big 3. And particularly in Australia, you see a lot of transactions in the geographic location space, where people on the eastern states are looking to expand west, people in Melbourne looking to expand into Sydney and Brisbane, or even if you're in Sydney looking to expand into regional New South Wales. There's often opportunities to expand geographically. Obviously, some of those are also international, so we can talk about people expanding into Asia or taking an Australian product or service successfully into Asia, North America, or even Europe. Those are the key motivators for strategic buyers, and they are the things that drive value. So it's important to understand them and think about how they might relate to you and or your business. The next thing to think about then is listed companies as buyers. Mostly as small businesses, we ignore this. Most of us think it's not possible to sell our business to a listed company, but there are a couple of key things to think about. The first one is this: there's a thing called private to public arbitrage. That is simply saying the long-term historical average value of the ASX is 13.73 times earnings. We were just talking about private companies being 2.5. Now, this is exactly the same as going into Westpac and buying US dollars for 60 cents and then selling them next door to NAB for 85 cents. You're going to make money every time. You just keep doing it until one of them runs out of money. And this is the same. Now, I'm not saying here that listed companies will pay 13.73 times. They won't. They'll often pay 6, 7, or 8, or even 9 times. And I've sold businesses previously where we've got 8, 9, and even 9.5 times from a listed company because of this valuation arbitrage issue. The fact is that they are valued at 13.73 times. If they can acquire an asset for something below that, they automatically get an uplift. And that's what the arbitrage is ultimately actually about. Interestingly and importantly to understand, listed companies in Australia and around the world, but this is Australian data, are holding a significantly high level of cash. In fact, if you look at this graph, other than in 2011 when it hit a 22-year high, Australian companies are still right up near the top of this graph holding the ratio of cash to other assets. They hold a lot of cash for 2 reasons. One, in case things turn down, there's a recession or there's a problem or there's some kind of global economic shock. But the other side of it, and the research is quite clear on this, the other side of it is, if you're the CEO of a listed company and you're looking for growth, one of the best things you can do is make an acquisition. And so having cash ready to go, freely available to use for acquisitions means that you don't have to wait for funding. You don't have to get approval from financiers or raise money in the marketplace. You've got the cash, you can go and make an acquisition. It means you can be opportunistic and take advantage of that fairly quickly. Now, I want to talk quickly about offshore buyers. Again, something that a lot of small to medium enterprise owners don't think about enough. Lots of offshore buyers in the marketplace. And interestingly, it's not all about China or Asia. There are buyers from those places in the market looking for businesses. But as has been the case for the last 100 years, the two biggest buyers of businesses here in Australia are from the UK and North America, the US. And that's always been the case. It's been the case for a long, long time. It's changing gradually to Asia. But the interesting thing that I'm interested in, two things: large numbers, 35% increase, 736 billion US dollars in offshore buyers, but the multiple at the bottom is important. 8.8 times earnings is a much higher average than the number we were talking about at 2.5 when we were talking about small to medium business valuation multiples. And again, that's a big opportunity that we need to think about and prepare our business to take advantage of. Now, I just want to talk about the last piece. This is really important: profit versus multiple. I talk to a lot of business owners who are so focused on improving their profit, and that's all they focus on. It's all they worry about. And I'm okay with that. Improving profit helps. Higher EBIT obviously helps. If we just take our average multiple, we talked about 2.5 times earnings. We've got a company that makes $800,000 EBIT, then that business is worth $2 million. If we increase the profit up to 1 million, now it's worth 2.5 million. If we increase it to 1.25, now it's worth 3 million. And even if we double it, even if we double our profit from 800 to 1.6 million, now it's worth 4 million. And that's all good. We've gone from 2 million to 4. We've doubled our money. That's fantastic by using profit and improving our profit. But what we need to understand is there's a lot of work in doing that. Taking a company from an $800,000 profit to a $1.6 million profit takes time, effort, investment, and embodies a lot of risk. And so whilst I'm certainly not saying don't worry about your profit and ignore it, it does help, but it's not the main game. The main game is in the multiple. The multiple really matters. If you look at this example, if we take a $1 million EBIT company and we don't change the EBIT at all, we leave it at $1 million, it is what it is. At our average selling multiple of 2.5 times, it's a $2.5 million transaction. If we can increase that multiple to 4, we get 4 million, 6, 6 million, 8 million. The maths is really simple. Importantly though, we've taken a $2.5 million business and turned it into an $8 million business. And we haven't improved the profitability. We've focused on the number one tip in terms of maximizing value. Multiple really matters. To achieve a higher sale price, it's much smarter to focus on how you sell and who you sell to. Strategic buyers, listed companies, offshore acquisitions, rather than trying to increase the profit. That is by far the best way to maximize the value of your business when you prepare to sell or exit. I hope that's been helpful. If you'd like to find out more, please reach out, touch base. Very happy to share the information with you, and hopefully we can help you achieve a successful exit for your business.